What are we talking about again?
Hedging.
What's going on, everybody? This is the St. Lucie crew here with our Tuesday convo with Mr. Bryan Wiener, who coincidentally has the same last name as the Dick Pic Man.
Dick pic, different pronunciation. So
How do they say his name?
Wiener,
They say it Wiener?
which is my nickname. So he chooses Wiener. I don't know if that's his thing. Unironic.
Anyway, so today we're going to go ahead and talk about hedging. And one of the topics that we're going to talk about, or Pete and Bryan here are going to talk about, is how to hedge out of that massive position of mine. What was it, the financials one?
The financial one.
The financial.
The financial one, and
The financial one.
Charlie and I talked about it on last Tuesday. I don't know if many people were watching, but
Right.
when you have such a big exposure, multiple names, you're
Right.
going to want to use an ETF as opposed to that actual stock. If you have a sector position on, the best way is actually sell the sector ETF, and XLF would have been yours. And the question is how many
Right.
shares you do, and it's a simple calculation. You would take the delta of your option. I hope we all know what a delta is in the options. Basically, one way to put it is the percentage chance that that's going to expire in the money.
Right.
And you take that delta, you multiply it, you remove the decimal. You multiply it times the amount of contracts you have,
Okay.
and you come up with your total delta for that name. Okay, then you multiply that times the stock price, and that's your dollar delta.
So that sounds like a lot of calculations.
It is.
So it's actually so.
You want to
simply
rock the
put,
notepad here?
no, simply put, if you're trading something that is say a 20 delta, okay, you got an option that's a 20 delta, just like what we have going on with these calls right now. You can literally multiply the number of contracts that you have by the delta, and again, you would multiply that by 100, and you would be able. That would be your stock hedging position you would need to isolate for a certain amount of time and for a certain amount of P&L to lock in the gain. So just an example is say we're long all these Goldman Sachs calls, 520 delta options, right? So that means that the stock goes up, say $5, and we make a ton of money on it. But the problem is there's not a lot of liquidity because it's going up. We've got a call. Not a lot of people are there for us to sell these calls on. So what are we supposed to do?
Well, let's show them that call. Let's show them that call. So, guys, let's do a sample here just so you can see what the hell is going on.
But in timeout, in this situation, we have synthetically 10,000 shares of stock to sell.
Right.
And by selling that stock at that moment in time, within a small price range, the shift in your P&L due to the change in the stock is going to be completely isolated.
So just an example, guys. We have 575 calls here, and you got your 12 delta here. You multiply that out, and that should give you your total contract exposure to the option, or to the stock via the options. Multiply that by 100, and that'll give you your theoretical stock position in that name. Okay.
So 7,200 shares, about 7,000 shares you have.
So 7,000 shares. So let's give you an example. Let's say that, how do I get this off this share screen?
Click that.
Or that.
This third one down. No.
Oh.
Jesus.
Third one down.
Yeah.
Okay.
There you go. So that.
So what we do is essentially, say it's 7,000 shares. The stock moves up $5. Okay. So your calls are going to be super in the money. You make a ton of money on that. What you do, instead of trying to sell out of the position, because liquidity may be very, very light, is what you should do instead is possibly short 7,000 shares. So what happens here is that, again, you buy your calls. Your calls go up in value. Now you're selling stock, 7,000 shares, equal amount relative to the delta. No matter the fluctuation in the price, now we're not talking about volatility or about time decay yet, no matter this fluctuation in price, you should be able to fully or relatively fully lock in the P&L to a certain extent there. Obviously, there are other characteristics of options such as volatility and time decay that you have to do a combo in order to isolate those.
If we go up $5, those are 100 deltas now. So now you're selling 70,000. Actually, you're going to sell 57,500 shares. Whatever.
Sure.
But there's a gamma constant. You have a delta in this moment in time. But if the stock moves, say 0.5%, and I'm going to do percentage because that's the best way to do things.
Sure.
Volatility is in percentage. Everything's in percentage. If you move a certain percent, then your delta is going to change. In this case, the 12 delta, if Goldman goes up 1%, actually, there's a gamma figure, 3.54. If Goldman goes up $1, the delta is going to switch from 12 delta to a 15.54 delta, because the gamma is 3.54. And so if you wanted to hedge them up there $1 higher, because you want to be a little greedier, or at $1 higher, Lucci reads the tape and he sees a bunch of sellers. Now he's a 15 delta. He's going to sell 10,000 shares of stock or whatever that you multiply that out. And when we go down $1, he's going to actually make money on that delta, on the gamma, because the delta is going to change back down to a 12 delta.
So the main reason why we're talking about this is because we at St. Lucie, when we're actually trading, run into liquidity issues. Okay, so again, say we're buying those calls. It took us freaking forever, say like 4 days, to just accumulate the position in those calls. When we actually make all that money in the actual trade, it's going to take us a while to unwind the actual total number of contracts. And what could happen is, because of the size that we have, we could tick the actual option down, an entire dollar. Who knows? And by actually going into the stock and hedging it out relatively 100%, you have a much easier way. It's going to require a little bit more trading, obviously, but what it's going to do is it allows you to maneuver yourself out of the trade. So, for instance, something Bryan brought up before was that, say we're long these calls, we make some money, and we hedge out so that we're isolating our delta, and we hold it, and all of a sudden there's a giant flash crash. Okay, there's a flash crash during the day.
Right.
What happens to our P&L? Our P&L doesn't change at all, actually.
Actually,
it goes up. It could go up because vol actually goes up. But before we get to the vol component, you just think about, what if Goldman Sachs crashed $10 in 2 minutes? Your 50-cent option is going to be worth 5 cents possibly. Okay, when it's worth 5 cents, there's probably going to be a lot of people willing to buy at 5 cents because the bounce is probably going to happen.
Right.
Market makers are willing to play. A lot of people are trying to get out, all that kind of stuff.
Right.
And there's area for you to actually let go of your option when there's actually liquidity to let go on.
Exactly. So when you hedge the position, not only are you now not at risk in terms of the stock price, you're now in a volatility position. Mm-hmm. By hedging, you are now effectively have an option that has a volatility price. It is a volatility level. So whenever the market crashes, volatility goes up. Everyone knows the SPX goes up. VIX goes up. Sorry, the VIX goes up. So you're actually, say, buying Goldman Sachs vol. The volatility right here is a 20.2. So whatever. If we puke, all of a sudden there's a flash crash. The volatility in that option goes from 20.2 to like a 35. And now it also depends. It is a Vega concept. I'm not going to get into that. I have too many thoughts in my head. But you essentially are making money on your hedge, and you're making money in volatility. You're losing money on the actual option price.
Price, right.
If you just think about it, you bought an option that is a 20 vol, and then you sell it at a 35 vol. Within a couple hours, you're making a shitload. You're making a lot of money.
For layman's terms, guys. When there is a flash crash, there is a component of the option that goes up in value. Okay, even though that the options price is going to go down, the options price going down relative to the stock, which is your delta exposure, is going to go down. But the volatility component of it during a flash crash is going to go up. So let's just go over that one more time. You are long your options. You're now making money. Now you're short stock to isolate the delta. You still have a vol component now. What Bryan's saying is that when you do that, you're isolating the delta, but you have a vol component. So if you don't have a flash crash and you hold this all the way towards, say the next day, you're going to lose on decay from volatility and time decay. But if you do have a flash crash and it just freaking drops, your short shares will prevent you from losing money from the option from dying out from the relative move to the stock price. But thankfully, there is a cushioning mechanism of the option, which is the volatility part, that is going to bump it up a little bit, where you're actually going to make money from being long options in general. That's going to give you a volatility exposure, which is super duper fun, thinking about what could happen when there could be a flash crash and how you make money, and not worrying about having to get out of the option when there's no liquidity.
And we're talking about, this is extreme. We keep saying flash crash. I mean, realistically, we're talking about
A giant move.
Yeah. And if you have a move like that and you're hedged, you're actually going to make more money than Lucci will trading this thing itself. Because you're short 10,000 shares of stock, and the stock drops down $10. You're making 100,000 shares, as opposed to how much you're going to make on this trade, maybe 25, 30 grand, whatever the case may be. You know, if Goldman drops $30, you're making 300 grand.
And so, like, another concept that we're working with right now is kind of getting in our heads that apparently it's really hard to make money in options, obviously, but it's also just inherently hard to get into an option and have it be, quote unquote, in the money or making money beyond the spread at that point. And so there's an inherent I guess, price for getting into an option, and there's an inherent nature of you should hold the option, actually, because it was expensive and difficult for you to get into it. So how do you hold an option? By hedging it out with stock. Now, another concept that Bryan brings up also is that, say that you want to get more complex. Not only do you want to isolate your delta from moving up in that point, you also want to have, you know, say that you make your move at 10:30, and you also want to take your profits, but you also think that at noon things are going to kind of fade out and kind of get a little slow, and there's not going to be too much movement, so you're going to get a little time decay, and you're also going to get a little bit of volatility coming back. So a concept that Bryan has introduced is that when you get your move, say it happens at 10:30 or 11 o'clock, you short, instead of a total delta exposure elimination with 7,000 shares, you only short, say, 5,000 shares. And what you also do, again, because people are bidding up for calls at that point, your calling volatility should be going up a little bit.
Depends on the name.
Depending on how fast it is. You short calls as well. So again, just to keep it simple, your long calls, it goes up in value. You do a combo of short stock and short calls. Okay, and what this does is essentially is that it prepares you for the noon action that's going to kind of fade out. That'll give you kind of a short vol and a short decay strategy.
We have to say, well, we talk about selling in the money calls, right? So he's talking about selling in the money calls as your hedge. So you're selling in the money calls, but that's also the same as selling an out of the money put. So there's some decay in that.
Sure.
So that's another component. So you get some decay by selling some of the put wing. You know, so you essentially have there's risk reversals, or there's other ways to put it, but your short put, long call, they're out of the monies both. You know, you're trying to hedge your decay. You're trying to time things perfectly,
which is really hard, guys, and it's pretty much impossible to do.
Yeah.
But the whole idea here is that sometimes, instead of trying to get rid of your options, the concept of hedging isn't for the purpose of hedging, but it's for the purpose of, you know, locking in your gains and working yourself out of the position in a more efficient manner to avoid liquidity risk and to avoid a lot of the issues. My main bone to pick with this type of trading, especially with Lucci's size, is that we run into like our market impact of our actual positions. So, for instance, we have a Goldman Sachs position. Goldman's relatively light. If I use the right order type, there could be a possibility I could just walk it down myself.
On stock or
on stock. And it could walk down the stock just trying to hedge out that position.
Right. And so that's when I bring up the concept of dollar delta and hedging with XLF. So assuming that Goldman has a beta to XLF of 1, the correlation's 1, then you're going to hedge your Goldman Sachs position with the XLF. The XLF is thick, it's low priced, and again, what I was saying was you get your delta. Your delta is 7,000 shares or whatever it is. 7,000 shares times the Goldman Sachs price equals this dollar delta. It's the delta in terms of dollars in Goldman Sachs. And assuming that Goldman Sachs and XLF move in the same percentage, then you're going to instead sell that same amount of dollar delta in terms of XLF. It's normalized by XLF.
So, again, layman's terms here is that instead what Bryan is saying is that when you play a single name, if you're too heavy in the name and you are worried about, even when your hedge could possibly affect the stock too much because of the market impact, what you should do is you should use the correlating ETF with a certain, because there's a ratio of how much Goldman Sachs occupies of XLF, that you should short some number of shares or even buy puts or short contracts.
Just assume, I wouldn't buy puts because you don't want the decay. Just assume that it's 1-to-1. So we're not going to write it out, but say the dollar delta is like $1 million. You divide $1 million by the XLF price, and that whatever that number is equals how many shares you need to sell in XLF to hedge your Goldman Sachs.
Yeah.
And then you're done, and you didn't affect the whole Goldman Sachs market. And if you're wrong, that's the beauty of it. You can get in and out of XLF very easily because it's a very low price stock. I don't know what it is, $15 or something. I don't know.
Yeah, and so in general, guys, something it's kind of like a disadvantage that traders have, or at least customers, is that they don't have cross-product margining. Okay, so when you're doing all this fancy hedging and getting into these big positions,
right? That is
like you have a margin risk, you have a concentration risk, so you can't get too heavy in a name. You can't exceed your buying power.
That's when you buy those deep in the money puts. Okay, not because we have to specify if it's in the money, out of the money, or at the money. So yes, you're going to buy however many in the money puts, whatever. If you have to. In the money, it needs to be like 100 delta.
So the in general idea, again, guys, is that there are ways to hedge out your position and to lock in your gains via some combination of stock and options, in the money or out of the money, and to actually get yourself out of a position and work yourself in it. Okay, and a disadvantage that customers have is that they don't have cross margining, and so market makers, a really fancy thing that they have is that, say there's short volatility in their entire portfolio. What they could do is they could pick a name that's just way random, and they could say, if this is low vol, I'm going to buy it to kind of hedge out my short vol book. Yeah. And they can literally pick a random name to hedge out the risk that they have. Literally, they could say, I'm going to hedge out Goldman Sachs with Procter & Gamble somehow. And it's really stupid, I think, that customers don't have this ability. But I think it's also really stupid that the OCC or anybody else thinks that that is a reasonable way of hedging properly a market maker's book. It's just ridiculous. And this occurs for futures too. So you're playing the SPY or XLF. You could go and you could trade after hours in the futures market to hedge out any overnight risk that you have for your current book. And with a fund like ours, and we want to scale up, that's something we'd love to do, and especially if the market's puking and we can see it after hours, and we're worried about a Goldman Sachs position that we're long. Right. It'd be great if we can use, the ES futures to hedge out our book, but it just doesn't work that way in terms of a margin standpoint or a buying power standpoint.
But for overnight risk, you can't, but I think you can trade the ES mini options 24 hours now. That's been going on for a while, I believe. Last time I looked, ES mini options trade 24/7. They're just wide.
Right. So again, guys, what we wanted to basically talk about today is just kind of conceptually what we've been thinking about of what we can do in terms of educating people on how to trade their options, and what we've been thinking about in terms of getting in and out of positions. So, like a couple weeks ago, we had a Giant Financials position, and it was literally a humongous pain in the ass getting out of position. We were down ticking like half the financials market because it was just so hard to get out of such large options. And considering that, again, market makers, when they see paper there, they're gonna scurry away. They're not actually providing liquidity for us. They are getting out of the way. They're hedging us out via the stock. Us trying to get out of the position is moving some of these stocks, and it's
Yeah, they're not gonna listen. Like you put a 500 lot there to sell, they're not gonna take it from you. Their liquidity is that you can hit me. I'm not gonna take it from you, and they have to pay a fee.
Yep.
Your customer, all this stuff. But once you're gone, they're bid there.
Yep.
You know, they might even bid higher.
Yep.
So
Yep.
you need to be greedy, kind of, and then just hit them.
Sure.
You just got to hit them, and you got to hit them a couple levels lower.
Yep.
You know, you want to sell
go through
three
it.
halves. You want to sell 3 halves, 360s, or whatever. You wait for it to be 370 bid, and if you have 500, you say I'll sell 500 3 half, and hopefully
just
your
sweep the entire
router
market.
sweeps everything.
Yeah, yeah. Unfortunately, our router does not do that. They actually prevent us from trading through. So if we say the bid is 370 and we say we want to sell 350, it'll prevent us from even doing it.
Really?
Yep. On
Doesn't it
rocks.
just warn you, and then it allows you to do it? You say, okay, I'll do it. I don't
Oh yeah,
care.
yeah, it does, but
Yeah.
it doesn't fill us at the 370 or 360.
Yeah, they're
It goes-
cheeky. They're cheeky.
Yeah, so it's a really funky line, guys. The options market is getting really gaming. In the
I mean,
past
really,
few
the
years,
fact
you know?
that you can lock an option market, I think, is absurd and ridiculous, and
Yeah.
and kind of really annoying. And
So, just to give a brief explanation of a locked market in an option, is simply that, say we have a Goldman Sachs call or a Bank of America call, the offer is 15 cents on Amex. Somebody could bid 15.6 on
Ice
Box
Gem.
or Ice Gem,
Yeah.
and it'll lock. It'll be 15 by 15. And what happens then? Tell me what happens when it's 15 by 15. You want to trade. How are you supposed to, what's your assessment
Well,
there?
I mean, if you want to buy, so who's on the offer?
Say Amex is
Amex on the offer, and I want to buy, fine, I'll take Amex. If I want
Sure.
to sell, if I am a router, if I'm an automated trading platform, I'm not going to sell into IceGem. This blockers because it's a fee. It's a maker taker exchange. I'm not going to do that.
Sure.
If I am that's like some whatever trader, and I want to sell it,
Yeah.
sure, I'll sell it. And I'll pay the half-cent fee after everything or whatever. That's just the way it is. But it's just a way to create a trading zone, and that's what those
Sure.
guys on IceGem and Nasdaq and PCOS, that's what they want to do. They want to create trading. Now, like an Amex is Amex, if it's a customer order, I'm not
can
sure,
route
but
out.
they might route out. They actually might fill on IceGem. It depends on the order type.
And so in general, guys, what we're trying to tell you a little bit is that consistent options traders that are completely in the options world that do not take delta positions like us are looking for something called edge, meaning that if your market makers are bidding at 20 cents and offering at 30 cents, and there's all this space in between, these smart options traders are waiting and actually using scanners to scan for dumb orders in between the bid and the offer, and depending on which exchange they are, they could try to flip out of it closer to the offer or closer to the bid, depending on which direction they want to take. And that is essentially also how market makers trade out there, automated market makers. They're literally out there looking for dumb orders that are hitting the market button that do not lean a little bit on the bid or do not lean a little bit on the offer, and they're literally just trying to scalp in and out of you as quickly as possible. And there are still hand traders that do it. Bryan's been playing with a proprietary scanner that scans for edge. Essentially, it looks for paper somewhere, and you can either trade it or you don't have to trade it. And it's a very difficult art, but in time, when your commissions are low enough and you learn the Greeks well enough, this is the game. It's actually, if you see the opportunities and you have fast enough execution, it's a very quick trade, and you can make a decent amount of money on it.
Yeah, I mean, these are trades where you're trading more vol. I mean, you're flipping for there's just a hanging order out there, and you're flipping into momentum, and that's one way. There's also volatility. It might be an offer, and it seems like it's a good trade, and you buy some calls, and you want to flip them, but it's actually that's the high of the day. But they really are good because you're buying them. Say the bid is 112 on an option. Some guys offering 113s. Well, you're not going to be able to sell 120s or something higher. But if you hedge them, now because the market makers are 112 bid, you buy these 113s. Now, if you hedge it with the delta, and that's actually you're buying it at a good volatility level, assuming that it's an out of the money call, and we go down, and you're going to make money in the volatility, you're going to make money in the gamma, you're going to lose in the premium, but the other two P&L concepts outweigh the
Sure.
loss in the actual premium. The premium doesn't matter. Premium is locked in with the hedge. It's all about the hedge, really, when you trade volatility.
So again, guys, just so you know who your participants in the markets are, you have your day traders, you have your customers that are just literally just trying to buy an option and sell an option, and they don't understand the spread, they don't understand the movement of stock, they don't understand hedging. You've got guys like Bryan and professionals that are literally looking for these types of transactions and just trying to play for the spread or a little bit of edge coming off of it, and it's important for you to understand.
I mean, this volatility curves is the basic thing is just to know if you're in a situation, if you're in a jam, and you don't want to just scratch or get out for a loser, and you really feel like this is a good buy for some reason, give it a shot, hedge it with stock, buy an in the money option to hedge it, buy in the money call if you're long a put, buy in the money put if you're long a call.
Sure.
And buy a call, meaning an out of the money call, and you're in a volatility position. Really, the best thing in that situation is you run away from that strike, from that option, and you go very far away, and you actually make money on your hedge, and that's another way to make money. So,
I think these concepts can especially be used for large portfolio managers that are getting humongous positions in stock or even in the options, that they should not try to alert all the market makers out there that you're about to dump a giant position. You should slowly chip into a hedge that is going to isolate your position and work yourself out of it. Unfortunately, the IRAs out there and the pension funds and even large hedge fund managers don't even understand these concepts. All they say is, I've got a time frame of 8 months. I want to go long, and I'm going to sell after that. Unfortunately, all the way through that, there's plenty of money to be made, and it's all about how much work you want to put into it and what you're actually willing to do to make that money. But yeah, so guys, I think that pretty much wraps it up for us here.
Maybe next week, if you guys want to tweet us some questions, like simple things, and we can answer them. And
yeah, Bryan and us all over here, when we get into the conversations, it is a very technical conversation because we're trying to explore ways to maximize the way that we trade and optimize it. So if you guys have any questions in terms of, I know that we have a couple fund managers in our chat rooms, and I know that we have some decent amount of followers, and it's really important for guys to understand these concepts, and this is all free material we're releasing on BTFD via St. Lucie, and
it's just like
you guys should look into it. It's very important.
The basic thing is that an option its price can be broken down in different Greek parts, and you can capitalize, you can make money, you can monetize these Greek components.
Yep.
If you understand them, and
there's also a really aggressive way that I've seen that is that you could get into a big position and you could do a partial hedge that could have a large impact on the markets. It could tick down the markets, and when you see momentum coming back, you can actually flash your size on the hedge, and you could cause a massive short squeeze, ultimately helping your original long position.
Yeah,
and there's so many ways to do it, and just know that. A lot of the poker playing kind of firms out there, I won't put any names out there because we actually kind of like what they do, that they actually play these games. They actually want to kind of have a significant market impact with their positions, so they can game people and they can game the short squeeze and they can game the momentum. Carl Icahn. Exactly.
We'll leave it with that.
Carl Icahn, we'll leave it with that. He is a genius in artificially creating these short squeezes. Is a fantastic way. I wouldn't say fantastic, but it's a very effective. It's a very effective way of causing havoc in the markets and also making a lot of money for people.
Yeah.
All right, guys. Charlie, how do we get out of this? Do we just continue talking, or like how? Huh?
We need Dad to come over and click us out.
Yeah, guys. But overall, guys, we this is all super really good stuff, and there's.
And we love talking about it. I love talking about it.
So always
I'll talk
ask
about it all night.
questions and always bring them on board, because I don't think you're going to get it anywhere else. Nobody else is going to give it to you. Maybe Left Hash will give it to you, but you know. All right, guys. Have a good one now.
See you guys.